Well, let's get started. Welcome to United Church Fund's Quarterly Town Hall. I'm Charles Buck, President and CEO of United Church Funds, and I want to thank you for being with us today. We look forward to these town halls that we do on this quarterly basis. They give us a chance to share updates on what's happening at UCF, in the markets, with the investment portfolio. Time, of course, doesn't permit us to get to everything of interest, and there's a lot to be concerned about. There's a lot going on, from bank failures to interest and inflation rates, from geopolitical conflicts and tensions to the ideological attacks on ESG and responsible investing. So we can't do it all, but we'll try to hit the things that matter to you. And again, if you have a question, please put it in the Q&A box at any time during our webinar. And again, if we can't get to you, we'll try to respond by email, and you can email us at any time. Let's go to the next slide, and I'll introduce our program today as well as our panelists. Stacy Pettis is our executive for institutional relationships, and she'll share organizational updates. Matthew Illian, our Director of Responsible Investing, will follow, providing the latest on our responsible investing activities. Matt Wagner, Vice President of Institutional Relationships, along with Stacy, will take us through the market and fund updates. And they're going to be in dialogue with our investment team from the Pension Board's UCC. That's Dave Klassen, Lon Kai, and Menotti Dhanaraj. A name that is not listed here, but deserving of mention, is Debbie Wiebowo from our marketing and communications team. Debbie is the one that we rely on to direct and coordinate these town halls, from the emails you receive to all the slides that you see on the screen. And so I want to say a huge thank you to Debbie. Well, I'm pleased now to turn it over to Stacy Pettis, who will get things rolling. So Stacy, I'll turn it to you.
Thank you, Charles, and welcome everyone to this quarter's town hall meeting. First, we'd like to share some of our organizational updates for the quarter. We wanted to make you aware that we issued a climate justice statement highlighting our commitment to center our climate work on those who are most impacted. This includes frontline communities adjacent to industrial plants, as well as indigenous communities where pipelines are crossing through their territories. The full statement, the full climate justice statement, can be found on our website at ucfunds.org, and we invite you to read through the entire statement there. Also, as the administrator of the Helen and Richard Brown Endowment, for 2023, we've issued over $180,000 in scholarships to members in discernment, and we're really excited to support them as they continue their journey through seminary. We also wanted to make you aware that the UCF portfolio had very minimal exposure to failed banks, Silicon Valley and Signature Bank. As you can see, we've actually posted that there was less than 0.03% exposure within the portfolios. Also, we've recently updated our client account forms. This is inclusive of transfer and allocation change requests, as well as our new account application. We ask that you use these forms when sending requests to our client services team. And we also want to note that your request will be responded to and processed within 3 to 5 business days of receipt. United Church Funds is also the sponsor of the Valerie Russell Luncheon that will be held at General Synod 34 in Indianapolis, and it's featuring Brian Stevenson as the guest and keynote speaker. We invite you to register for that event if you are planning to attend General Synod. We'll also be a part of the Back Bay Mission annual meeting as a lead sponsor for that conference as well. And now we'll transition into our poll questions.
Well, good afternoon, folks. And Stacy, thanks for providing us those updates. We're going to start you off with a poll question. And it is the following: when was the last time There's two questions. When was the last time the federal minimum wage was raised? You can go ahead and start answering that. And then the second part of the question is, what is the federal minimum wage? We'll give folks a minute to jump in here. See quite a few of you responding. And the overwhelming favorite for the minimum federal, for the level of the minimum federal wage is $7.25. That is correct nationwide. We have a couple of folks that mentioned $15.50. Those perhaps are some of our clients in California where that is the minimum wage. $15.74 is the minimum wage in the state of Washington. And $6.55 was the former federal minimum wage. Now that $2.13 is the federal minimum wage for servers and tip staff as well. And you'll see here at the top, 2009, 1995, and 19, it looks like split pretty evenly between 2021, 2019, and 1989. So as a segue from this question, I will bring in my colleague, Matthew Illian, not to put him on the direct spot, but I know he has a slide on this as we move forward. Matthew, what is the answer, the correct answer to that first poll question? When was the last time the federal minimum wage was raised?
Lots of good answers there. The last official raise was 2009. So it's actually been a while, but not quite as long as 1989. But has been a long. It's actually the longest stretch in the recent history that it's not been raised. So with that, let me jump into our section here where we talk about our the work that we're doing on your behalf as shareholders to push for a more sustainable economy and for corporate accountability. And maybe before I jump in, I want to make sure from Debbie's end that my video is sort of accessible for the town hall, because I still see Matt Wagner's name. But Debbie, while you're working on that, let me just transition to say that this summer, the UCC will be celebrating the 10-year anniversary of the fossil fuels resolution, calling on all settings of the church to engage in various strategies of fighting climate change. And 1 year later, the UCF, that's when we launched our Beyond Fossil Fuels funds with 10 founding investors and $20 million committed. Today, those funds stand at $141 million and 115 investors. And the returns on those funds have been strong as well. We're not going to list them here, but when you do get the slides for this presentation, the appendix, you'll receive an email. You'll receive an email. You can look at the returns, which have been some of our strongest performing funds. And we also, at the upcoming General Synod, will be providing a report on all the work that we're doing to support the Beyond Fossil Fuels efforts. So, Debbie, if you'll go to the next slide, you can see there the growth of those Beyond Fossil Fuels funds. And we're proud that we are one of the first investment organizations to come out with a Beyond Fossil Fuel strategy, and look forward to how that fund will grow and develop over the coming 10 years. So as I transition to the next slide, if you've attended any of these town halls, you'll know that we're big fans of ICCR, or the Interfaith Center on Corporate Responsibility. In fact, our president CEO, Charles Buck, sits on the board. This year, ICCR members filed 376 member-sponsored shareholder resolutions. And you can see on this slide that climate change, as well as diversity and racial justice, are the top two categories this year. At UCF, we accounted for 11 of those shareholder resolutions. 3 of which got withdrawn, meaning we came to an agreement with the corporation that they were able to commit to fulfilling the ask within those resolutions. But that leaves 8 resolutions that are going to a vote, and we will be reporting on the results of those votes in the coming weeks and months, because this is the season for annual shareholder meetings. As we turn to the next slide, last Tuesday was our first shareholder resolution that came to a vote. And this was calling on the bank to report on analyzing Citigroup's human rights practices with regard to Indigenous peoples. On this resolution, we partnered with an order of nuns from Philadelphia and co-filed. And it was reported that this shareholder resolution received 31% support, which we were very happy with. It was not long ago that a resolution like this would be, lucky to get 10% support. And so, we're going to continue to press issues like this. One thing that was unique about this shareholder resolution, as we turn to the next slide, is that it was presented by an Indigenous activist named Tara Huska. And as you can imagine, hearing a resolution like this directly from an Indigenous person brought a certain amount of attention that might not otherwise be drawn. And so we're excited about that. Next month, we will be presenting a resolution at Dollar Tree, calling on the board to analyze the corporation's compensation practices. And you'll see here on this slide that Dollar Tree has over 200,000 associates and reports a median pay of $13,490. And for context, this is below the federal poverty rate for a single person, well below a living wage. Unlike other competitors, including Walmart, Target, Dollar Tree is not committed to a decent standard for starting pay. And so many of its associates are paid the prevailing minimum wage. And as Matt Wagner mentioned, that's $7.25 in states that haven't set higher thresholds, including California, Washington. So there's 7 states, predominantly in the South, that fall into that federal minimum wage starting at $7.25, which is far half of a living wage. And in the resolution, we draw attention to the fact that this particularly hurts women and people of color who make up the majority of its workforce. This resolution also draws attention to the fact that our country hasn't raised minimum wages since 2009. So if you go to the next slide, you can see this is the longest stretch in recent history that the federal minimum wage hasn't been raised. So you see that red line. So basically 2009, 2010, 11, 12, 13, 14, 15, all the way up to 23, it's been at $7.25. And you can see from an inflation adjusted, sort of framework, that back in 1968, it compares to the equivalent of $12.12 as a minimum wage on an inflation adjusted basis. So we are calling on corporations to set, ambitious or to raise minimum wages, but we're also drawing attention to the fact that, it's just been so long since the federal minimum wage has been raised. And this really impacts the people, who are hired for those, starting wages, often women, often people of color. And so we have work to do as a country. We have work to do as shareholders on this. And if we'll go to the next slide, we have another poll question. So I'm going to turn it back to my colleague, Matt Wagner.
Matthew, thank you for those updates. Greatly appreciated. And if anyone was paying attention to that last picture, as we pull up the slide, Matthew was featured in that picture where he was downtown by the Charging Bull statue with other folks who were calling attention to equal pay and fair wage, the fair wage issue. So,
and Matt, let me just add, we were there with tipped workers whose, again, their wage at a Denny's, for example, is like $2.65. with the promise or the hope of getting tips, but they were there saying that that's not enough, and they were calling for one fair wage. And so they're really asking that the minimum wage apply to tip workers as well. The restaurant industry has done a good job of kind of keeping them out of any of the federal minimum wage updates.
No doubt. Well, thank you for your report. Thank you for representing our organization and our clients, not only for that initiative, but for many others. I'm going to go ahead and launch the second poll question. And this is on the your outlook for the economy. So the question is this, one question this time. What is your outlook on the economy in the coming year? And you can answer by saying moving into a deep and prolonged recession, the economy will remain status quo, will slightly worsen before improving, or is headed into a rebound. Give everyone a chance to respond to that. And as you're responding to that, I will reiterate that as you have questions as we go through these slides, please put those in the Q&A box, which is in the toggles below. And we'll be happy to try to get to as many of those as possible at the end of the town hall. It looks like most folks have participated in this poll. It looks like the majority, over 50%, say that the economy will slightly worsen before improving. A little over a third say the economy will remain status quo, with a handful of folks saying that we're headed into a deep and prolonged recession, or that we're heading into a rebound. So thank you for participating in that poll. These are helpful tools for us to get sort of the pulse of where our clients are as it relates to the economy and how we position portfolios. Debbie, if you want to move to the next slide, we're going to roll into some market analysis, and after the next couple of slides, I'll be joined by our investment team who have joined us for this town hall and often join us, Dave Clausen, Manothi Dhanaraj, and Lon Kai, and look forward to speaking with them. These four themes come out of some of the conversations we have with our clients and the conversations that our investment team has with our managers and with other folks that from which we derive research. And just to give you a little bit of a background as to some of the slides that are going to be featured over the next few minutes on this town hall. We note that in Q1, equity markets regained their footing after obviously an exceptionally challenging 2022, both for equity markets and fixed income markets. The S&P 500 was up about 7.5%. International developed markets up about 8.5%. And then trailing those healthy quarterly returns were emerging markets and U.S. small cap. Interest rate signals, of course, in 2022, we saw dramatic increases in interest rates. And one of the things that I think we're watching, and which we might touch on in the coming slides, are the rate spreads or the gaps between different treasury rates, the 2-year, the 10-year, the 20-year, and the 30-year. And while we saw rates come down just a little bit in Q1 of 2023, and spreads remaining essentially unchanged, this is certainly something that we're watching very closely as it relates to how the Federal Reserve is moving rates up and down and reacting to economic conditions on the ground. And finally, I know our investment team is always watching very carefully the macro risks, U.S.-China relations, and the Russia-Ukraine conflict getting certainly top billing, but also on the domestic front, the debt ceiling, impending debt ceiling vote, and other domestic issues that can move markets, including the health of our banks. If we flip to the next slide, this just gives our viewers on the left some of our indexes that we watch very closely. The top half of that list are equity indexes. The bottom half, roughly, are bond indexes. And you can see in that 2022 column, universally red numbers, essentially with the exception of that bottom line for commodities, universal red numbers for both equities and fixed income, but that nice bounce back in Q1. And still, when you look at 3, 5, and 10-year average annualized returns, fairly healthy returns for equity asset classes. And the two charts on the right are noting the increase that we've seen in interest rates, essentially from late 2021 and through 2022. And then if you see there in that Q1 of 2023, rates coming down just slightly. If we go to the next slide, I'm going to bring in Dave Clausen with a question. Dave, welcome to the call. Thank you for joining us tonight. So this slide is a historical depiction of about the last 25 years or so of the S&P 500. And clearly, as this slide indicates, the market's at its fair share of ebbs and flows over this time period. As we move it deeper into 2023 and think about 2024 and beyond, how's the investment team positioning portfolios to take advantage of future upside given current valuations in U.S. equities, but still managing some of the potential risks and market movers such as continued increases in interest rates and inflation? Dave?
Thanks, Matt, and it's terrific to be here with all of our UCF clients. It has been a wild ride. If you had told us at the beginning of the year we'd have a number of bank failures, including Credit Suisse over in Europe, you would have said the market would have been down. So it's always puzzling as to the short-term direction, but certainly there's been a dramatic rebound both in the fourth quarter of last year and the first quarter of this year. I'd kick off this Q&A section, by basically saying that this is not a particular time to be heroic, to be relatively invested and not out of the market, because we've had a significant correction. But let me give you an example of where I think our approach has been really helpful in navigating things. The most affected part of the market is small companies in the US, particularly because there's a number of regional banks. Our manager in that section is Channing Capital, who's got a very active approach to investing and doesn't own a number of the regional banks and has done relatively well. So that foreshadows a number of the answers that we'll give. But I think I just summarize it, Matt, by saying we're relatively fully and fairly invested relative to target in equities. And Lon will talk a little bit later about our position in bonds.
Terrific, terrific. Debbie, if we could go to the next slide. Dave, I'm going to bring you back in this one on this slide just really quickly. This talks about nominal yields and real yields going back to the 1960s, of course. Dave, you've been around long enough to manage a number of market cycles, not all the way back to 1960, might I add, but certainly back over the last few decades. Can you give us maybe an insight into your experience when we've had these periods of inflation and these sort of wild rides on inflation to the upside, and maybe some of the factors that our clients might want to keep an eye on, both related to portfolios and also maybe some key indicators to watch?
Sure. Well, just in summary format, the 40-year cycle and the downtrend in rates is broken, and we know that, and things are acquiescing, at the moment. But we think structurally there'll be a higher level of rates in the future. However, we are more favorable on fixed income. That said, we're more favorable on fixed income than at any time we've been over the last 10 years because of the starting points in yields. So to the degree to which companies can pass along the inflation, and I think there's a question a little bit later, Lon will speak to our reinvestment in some areas of the fixed income market. We're a little bit more productive and constructive, I should say, really on the 60-40 portfolio, 60% stocks and 40% fixed income.
Terrific, terrific. And I would note to our clients that 60-40 portfolio, many of you know, as the UCF Balanced Fund and also the UCF Beyond Fossil Fuels Balanced Fund, where Dave and his team have the ability to have a target allocation of 60-40, but then the ability to go plus or minus 10%, which has been a real tool for our investment team to navigate some of the risks and also take advantage of some of the opportunities that we've seen, back, over the last 5 years for sure. Dave, thanks. Lon, I'd like to bring you in for the next slide, and Debbie, if you could push it forward to slide 18. There it is. So, Lon, I have to give you a real world brief story here. So this morning I was sitting on a call for an organization that I'm affiliated with, and there was another investment manager that was there, and they noted to the folks in the room that they were not in favor of adding to fixed income in the near future. And I knew that I had this slide in my back pocket for you tonight. So I'll make sure to share your answer potentially with that other manager, but Lon, by many accounts, 2022 was arguably one of the worst year for bond investors in recent decades. So this slide relates to fixed income valuations, and my question for you is how we are positioning our fixed income investments given the current interest rate environment, the current bond valuations, and what we see moving forward.
Well, thank you, Mike, Matt, and happy to be here. It's an excellent question. For fixed income, we all know when rates go up, the bond price come down. So in 2022, it suffered a loss. However, looking forward, given now that the rates has increased so much, the aggregate expected return going forward is much better, and then arguably probably the best comparing the last 10 years. Within the fixed income portfolio, last year, UCF portfolio is benefit from a small allocation in bank loan. Bank loans are floating rates for instruments, and then they did well compared to other segments of the fixed income. But we think that the fast and furious rates increase is kind of behind us. So we're in the stage of redeeming the bank loan and try to deploy in other sectors. We wanted to create value over time for the UCF fixed income. But coming towards kind of my first statement, as the fixed income is looking quite attractive compared to the last 10 years. And then that Dave alluded to too, is that because rates has increased quite significantly. And if you look at this chart, the current expected return is on the top end of the last 10 year, way above the 10-year average. And I think your client, Matt, is probably right. In the near future, is still some hesitation in terms of deployed rates, deploy fixed income, because rates has come up, but they come down too after the regional banks failure. So it's less attractive as this picture will be, and the spreads hasn't priced in a full recession yet. However, we look at fixed income on a holistic basis as a standalone option, and then also as the balance fund, kind of the building block. So in the fourth quarter of last year, we put some cash into work, and which has appreciated quite a bit. So the message is really going forward, fixed income asset price is attractive. Is it imminent allocation? Maybe not.
Terrific. And as always, our investment team has their eye on the ball, and I hope you all caught that we did deploy some the investment team did deploy some cash in the balance funds into fixed income late in 2022, which has been additive to returns as rates came down in Q1 of 2023. Debbie, as we go to the next slide, I want to bring in Manothi Dhanaraj. Manothi, great to see you, and thank you for joining us. We have three different charts on this page, all having to do with the relative strength of the U.S. dollar. And not all of our investors, not all of the investment committees that UCF deals with have a really keen understanding of how the value of currencies, and specifically the dollar, impact our investments overseas. So can you give a summarize for our viewers, sort of a high level of the valuation of the dollar and how it impacts our allocations to international investments?
Sure, I'd be happy to. So maybe starting with the chart on the left-hand side, you all can see that the US dollar has weakened since September of 2022. And this has really helped international markets, especially emerging markets. And so many developing countries rely on US dollar denominated debt. And as the dollar weakens, their cost of borrowing also gets lower. Also, the weakening dollar also typically implies stronger global growth. Then on the flip side, looking at the top right corner chart, it shows the US trade balance is coming down. And a devaluation of the dollar tends to negatively affect the competitiveness of non-dollarized economies as their currencies get stronger, and as a result, their goods become more expensive. That said, US exports become cheaper for those countries. And then the bottom right corner chart shows the interest rate differential between the US and other markets such as the ECB and Japan, which is coming down as those markets have started to increase rates, which also will reduce investors flocking to the US for higher yields. So as of the end of the first quarter, we had a slight overweight to international markets, including emerging markets. And this slight overweight increased over the quarter, as you noted earlier, Matt, that international markets did better than US markets during the quarter. So going forward with international valuations lower, higher expected growth, the dollar coming down, and the reopening of China, we find the international markets, especially emerging markets, to be more favorable. And thus we continue to diversify our portfolio.
That's great, Manoti. Thanks for sharing that. And there was another slide that we've used with some portfolio reviews, and a chart that you had sent over to us that also described that just sort of the cyclical nature of US equity bull runs, and then followed by international equity runs, where there is a historical precedent for international markets to potentially outperform US markets after US markets have had a really strong, a strong few years. So all backs up the idea that our international diversification is a really important tool in our balanced fund strategies and in diversified portfolios generally. Thanks, Manoti. Excuse me. I'm going to bring, as we go to the next slide. Excuse me. I'm going to bring Lon back in. And again, we're talking a little bit about interest rates and specifically the Fed fund rate on this chart. And many people, Lon, on the call have probably heard the term "don't fight the Fed." And so I want to ask you a little bit about the Fed and different interest rates. And maybe you can point out some of the signals that we watch so that we don't end up fighting the Fed, and what leads the federal funds rate expectations that we see to the far right-hand side of this chart. Lon, go ahead.
Yeah, Matt, I think don't fight Fed is rule of thumb that we follow very closely. I use this chart as an example. If you look at the chart closely, there is this green line, which is the market expectation. And then there's a blue line, which is FOMC's expectation. And that dot is taken by the last March meeting. The green line is the market as of March 31st. And as all of you know, there's a lot of regional bank issues going on with the failure of Silicon Valley, Signature, and most recently, First Republican. With that, the market is expecting the Fed either pause or quickly cut the rates. And that's a green line. However, what the Fed showed at yesterday's meeting by hiking another 25 bp, which essentially put you at around 5.1 because the rate is 5 to 5.25%, is it hasn't budged yet. So they're trying to provide liquidity through the bank funding facility and then also the balance sheet, but they still hike the rate. And then largely they will probably pause, but not significantly cut or as fast as the market expecting now. And with that, the last 2 days equity market came down. So don't fight the Fed. When the market is too optimistic or pricing way ahead of the Fed, then the pings will come first, then the gain.
Thank you, Lon. Appreciate that. I hope that our investors are listening closely, because that is really helpful information. The last slide that we're going to cover before we go into Q&A, I'm going to bring Dave back in. And this particular chart is about unemployment and wages. And gives us an idea here back all the way to 1972 about the unemployment rate and year-over-year wage growth. Clearly, you can see a handful of spikes on that on the dark line, which is the unemployment rate, particularly around April of 2020, of course, the COVID pandemic. And wage growth is the light blue line. And so, Dave, bringing you back in to answer this question, we've already heard tonight about, of course, about our commitment to fair wage initiatives. So if you would walk our viewers through wages and employments as drivers of economic forecasts and our strategy and how we might use this type of data to position our portfolios.
Thanks, just being a busy beaver and answering some of the great questions in the chat.
I appreciate that.
5 or 6, so it's really great interaction, which is the whole point of all this. But I would say briefly and echo Matthew Ilian's remarks that wages for so long have been suppressed, particularly in lower income areas and in retailing and other industries. So it is heartening to see the healthy improvement in wages in some quarters, benefiting many. And here, I think the bottom line is that because we have a predilection and a preference where it's prudent for active management, it's really incumbent upon those managers to locate the firms that can both pay a fair wage and still be sustainably profitable over a long period of time. So I think that's really the way in which we approach it. And obviously, a lot of the analysis on wages and higher inflation folds into our view on the market in general and valuations. But I think the key point is the sustainability of the underlying companies and good managers who are keeping their eye on the ball relative to profit margins. Maybe just one more thing. Profits have generally held in there pretty well. Which I think has been the reason why the market has stayed relatively healthy. So that will be an enduring theme, profit margins, going forward in terms of the prognosis.
Dave, thanks for that. Appreciate it. And we're going to move to, if we want to go to the next slide, we're going to move to some Q&A. And we've got a number of really good questions pulled up here, and I'm going to pull up a few of those. The first one that I happened to see and that I wanted to get to is from Grant Armstrong. Grant, good to have you on the call. How safe are the cash and equivalent fund investments in the event of a continuing or more severe banking crisis? It's a great question. I'll be happy to answer this, and then if anyone from our investment team wants to chime in. Our cash and equivalents fund is essentially a stable value fund, meaning that it does the underlying principle of your investment will not change. It does generate a yield. We do not charge you a fee on that fund. The yield as of the 1st of May was about 4.75%, I believe, if I'm not mistaken. And as it relates to the safety of the cash and equivalents fund related to the banking crisis, I would say that those are not interconnected necessarily. Our cash and equivalents fund is tied to a 7-day SEC yield of ultra short-term securities and providing our clients with liquidity. Dave, I don't know if you want to chime in at all to nuance that answer any further, but
yeah, no, great question too. And the investments are in money market funds that are custodian, and generally there the asset, the investment is matched by our investment is matched by underlying investment in terms of the matching of duration. So there's no mismatch and fear of deposits fleeing. So it's not in a deposit account; it's in a money market account with appropriate underlying investments.
Thanks, Dave. We had another question about the balanced fund's first quarter equity return and the bond return. The UCF balanced fund returned about 6 3/4, if I'm not mistaken, over the quarter. The bond portfolio returned about 1.6. The equity portion of the bond fund returned about 10.5 overall. Carl, thanks for that question. Again, as when you receive the link to this presentation in the appendix, you'll have the performance of all of the funds, which we appreciate. Rex has a question. Our investments exceed $250,000. What is the level of protection in UCF? United Church Funds is like other investment advisors in that we do not benefit from FDIC, excuse me, insurance. These are the accounts that you have with us do not have FDIC, excuse me, insurance up to that $250,000 threshold, similar to a bank. Bing Heckman has a question. Why is it that the S&P 500 or ETFs that mirror it typically outperform the domestic equity funds? Bing, I think you're referring to the domestic core equity fund for us, which is benchmarked to the S&P 500. There are a number of reasons why actively managed mutual funds over longer periods of time don't keep up with unmanaged no-fee benchmarks. Our use of cash would be one, and fees would be the other. Happy to unpack that question a little bit more in a post-meeting follow-up, Bing, if you have that. We have a couple of minutes left here, and trying to get to just a handful of other questions. Great questions, by the way, and appreciate that. Another question, should preparations be made to portfolios for the debt ceiling negotiation? Dave and team, any thoughts on, by the way, in the Q&A, the person that asked this has negotiation in quotation marks, which is appropriate, given that there's not much negotiation.
Could have put food fight.
Yeah. Any thoughts on that, Dave?
Yeah, we had a back and forth, and obviously we're talking to managers about this. The sense is that we don't want to get too complacent here. The risk would be in the shorter dated treasury bill maturities, for the most part. So watching that, but I think there is a bit. I think it's a great question because there is a fair amount of complacency because every single time we get to the brink, we pull back from the brink. But I think in this area of brinkmanship, it's worth considering the risk. So it's part of the reason we're not dramatically overweight equities and still have a little bit of cash around.
Perfect, thanks. Manothi, I may bring you back in. We had a question, or anyone from the investment team. Stephen Hotchkiss, Stephen, good to have you on the call. Has a question about emerging markets and why we might have that as a portion of a diversified strategy, even despite the fact that debt service costs are rising in emerging markets. Of course, debt service costs are rising for all companies, including small cap companies here in the U.S. And I know we talked a little bit about the attractiveness of valuation in emerging markets given the dollar cycle. Are there other reasons why emerging markets, outside of maybe the dollar or other factors, why emerging markets might look attractive? And by the way, I would note for our clients here, emerging market equity makes up less than 5% of the overall allocation to the balance fund, so it is a very small piece of the pie. But happy to throw that out to our investment team for a response.
Yeah, I'll add one thing, and then if Dave and Lon have anything else to add. So besides the currency movement, and if the dollar, continues to weaken and that benefiting emerging markets, but what we're also seeing is that growth in the emerging markets is looking stronger. And as the US seems to potentially be going into a recession, some of the emerging markets in terms of their growth rates are looking better.
Thanks, Manothi. Dave, were you?
Yeah, no, I think that captures a good part of it, and really the approach we're taking in emerging markets is a quality-oriented approach with our manager RBC, a Canadian firm, and the potential also to pick stocks within that context and add significant value versus benchmarks has been really a part of the approach. So again, an active approach there. I think we've all been, in the meetings with RBC. They've really done a fine job of outperforming significantly. So it's a big world out there, so to speak, and there's good pickings for good companies and good countries.
I would note too, for the benefit of our investors, that our emerging market exposure might be different than what they experience in other funds that have emerging market exposure, only because of our screens. We have human rights screens that are in place globally that probably reduce our exposure in certain economies like China, for example. And so to Dave's point, I think that sort of quality bias in emerging markets has been a benefit to us, and I agree, RBC's done a terrific job. Last couple questions here. Doug Smith asks if we can share the shareholder resolution, the 8 companies that we're doing shareholder resolutions with. Matthew, I'm sure we can do that. Do you want to chime in really quickly with a yay or nay?
Yeah, we can send a slide out, but it's Meta, Alphabet, Google, Dollar Tree, Dollar General, Yum Brands, Citi, Goldman Sachs, and Westlake Chemical are the eight that went to a vote or going to a vote.
So if you all want to read between the lines, that means Matthew's a very busy guy. And we've got a lot going on behalf of our investors, and we'll be happy to send those out and talk more about those engagements as we move forward. And as we close out tonight's call, I want to thank everybody for joining us. I want to thank my colleagues for sharing their expertise and their experience and their passion, not only on tonight's call, but with our clients every single day. It's our mission at United Church Funds to support our clients by providing a competitive and responsible investment platform that both meets your financial objectives and also is also aligned with your values. And so we're incredibly grateful to be of service to you. Again, thank you all very much for being on the call this evening. Be looking for the link to the recording and this slide deck. And if you have additional questions after the call, feel free to reach out to our team. Our contact information is on our website, and we would welcome the opportunity to discuss it with you. Thanks again, everyone, and have a wonderful night. Take care.